Let's look more closely at the methods of valuation used by venture capital and other investors when assessing the value of seed and early stage startup companies. Valuing a seed or early stage company presents certain challenges. The company is new, has no history, so valuations based on historical earnings and revenue performance are of little use. As the company is so new, management's projections are hypothetical, and they're not grounded in historical performance. So discounted cash flow and other valuations based on projections of future revenues and income are extremely speculative. In the seed and early stages of startup development, sales and earnings projections may be so speculative that they're not taken seriously at all, and may be too unreliable to form the basis of valuation. Reflecting the highly speculative nature and the risks involved, the discount rates commonly applied to startups by venture capital investors are in the range of 25 to 75% per year. As it may take the average high technology startup 5 to 10 years before cash flow turns positive, the net present value of these positive cash flows can be very small after the discount rate is applied for each year. $1 earned in year 10 with a compound discount rate of 60% applied each year has a net present value of less than 1 cent today. So the earnings of the company can never justify an investment based on a discounted cash flow analysis of the company's projected retained earnings. However, investors do use the discounted cash flow model when valuing early stage startups, but they focus on potential terminal value, the value of the company at the point where the investor can exit and sell shares via M&A acquisition or IPO. Although the cash flows generated by a technology startup may be negligible, the price paid by a corporate acquirer or a Wall Street investor in 5 to 10 years may be substantial and justify an investment when discounted to net present value today. When the discounted cash flow method does not focus on cash flows generated by earnings and focuses exclusively on the potential value at exit, this technique resembles the return on investment method of valuation. With 0 in sales revenue and 0 in earnings, the revenue and earnings multiple techniques value the company at 0. The only valuation techniques that make sense in the seed stage and early stage are return on investment, rule of thumb, and comparable deals. In fact, seed rounds are often completed without setting any value at all. The money is invested as a loan that converts over to equity when a valuation is fixed by the lead venture capital investor at the next round of funding. In the early stage, the company may have some revenues, but little or nothing in the way of earnings. The earnings multiple method is not very helpful in setting a valuation, and the revenue multiple calculation is rarely used. As in the seed stage, return on investment, comparable deals, and rule of thumb are the most useful techniques for an early stage startup. The potential return on investment is obviously critical. Entrepreneurs are sure to meet resistance from Sandhill Road investors if the business plan projections do not show the company growing to IPO candidate stage within a 3 to 5 year period. If the company is not projecting profitable revenues of at least $10 million a quarter within this period, the discounted cash flow analysis may raise serious questions about the plan and the potential upside for growth. The top-tier Sandhill Road venture capital firms are looking for a substantial share of a startup company, normally in the region of at least 15 to 20% of the total shareholding. They're also looking for huge potential returns like 1,000% or 10x over a 3 to 5 year period. When negotiating with lead VCs, it's important to understand where they're coming from. Although it seems to have little relationship with the company, the milestones achieved or momentum generated, the return on investment technique is commonly used by investors in seed and early stage companies. Here's an example of a rule of thumb valuation that might be applied to a startup company by a venture capital investor. This hypothetical investor might value a seed stage company with a fair amount of momentum at $1 to $3 million. And if the company has generated impressive momentum, perhaps achieving milestones and generating a positive buzz in the industry, the valuation range may increase to between, say, $5 and $15 million. A company in the expansion stage with good momentum, perhaps signing up significant customers, may be valued at between $10 and $50 million. And a company preparing for IPO in the mezzanine stage with impressive momentum could be valued at $200 million or higher. This type of rule of thumb guideline may not be very scientific, but it does reflect the way many seed stage and early stage startup companies are valued by venture capital investors.